Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome Stephen Perrenod. He is a PhD in astrophysics and is here to walk us through some mathematics about Bitcoin. Stephen, welcome to the show.
Thanks so much for inviting me, Nick.
Stephen, I would love to start with the difference between exponential and power law. People have brought it to my attention that I'm using the word exponential incorrectly to describe Bitcoin's growth. So can you start there, please?
Yes, certainly, Nick. The simplest way to think about an exponential, especially for people that have a finance background, is compound annual growth rates. So if you have a bond over the period of time, you're getting a same return. Or if you have an investment in the stock market with the S&P 500, it may average 9%, 10% over long periods of time. And those are compound annual growth rates. And if you have a constant compound annual growth rate, you have an exponential function. It's e, the base of the natural logarithm, to some number, some power, and that number isn't changing. So just think in terms of constant compound annual growth is exponential. Now, a power law is something that we see a lot in physics. For example, gravity is a 1 over r squared power law. That means as you double your distance from the attracting object, whether it be the Earth or the sun, that the force drops by the square of the distance, which is a factor of 4. So it's a scale kind of thing. You double something and then you raise that to some power. And that power could be 2, that's a parabolic or quadratic relationship. It could be 3, that's a cubic relationship. It could be any real number. And we're going to see larger real numbers. So the difference is that is not constant compound annual growth. It can have more rapid growth early on. It does have more rapid growth early on. And it can be faster than an exponential, depending on the details.
So Bitcoin has experienced exponential growth in perhaps its early years. But since then, we cannot say that Bitcoin has experienced a constant increase in its compound annual growth rate. Is that how you would describe it?
No, I would disagree with that characterization. Bitcoin has never been on an exponential path. It's always been on a power law path since the beginning. Now, it was noisier the first few years, but it locked in and got tighter and tighter. But all you have to do is look at the return during the first epoch, then look at the return during the second epoch, and then look at the return in the third epoch and the fourth epoch. And for every epoch, the return was less. It's been declining from one epoch to the next. It was never on an exponential mathematical relationship. It was never a constant compound annual growth rate.
And what about the adoption of Bitcoin? Is that also a power law, or has it experienced any exponential functions there so that we can get our lingo correct?
Right. That has also grown as a power law, and it's been roughly as the cube of time, but not precisely, and it depends on the size of the wallets and so forth. But if you take a minimal wallet that has some non-zero balance of Bitcoin, that number has grown roughly as a cubic relationship with time, a power law to the third power of time.
The Bitcoin Layer is sponsored by Unchained, the undisputed leader in Bitcoin financial services. Unchained empowers you to take full control of your Bitcoin with collaborative multi-sig vaults, in which you own 2 of 3 keys and you gain a Bitcoin security partner. You can purchase Bitcoin directly into your cold storage via Unchained's trading desk and eliminate all exchange risks. Unchained also offers the best IRA in the industry, where you can convert your existing 401ks or retirement accounts to Unchained, all while keeping control of your Bitcoin private keys. Don't pay more in taxes than you have to. Talk to Unchained today. Go to unchained.com/TBL for $100 off when you sign up. Ifani is a secure mobile carrier that helps prevent SIM swaps. SIM swaps are sophisticated social engineering attacks in which hackers steal your phone number by gaining access to your information. Ifani lets you sign up with AT&T or Verizon through them, but Ifani protects your mobile number from being stolen by hackers. So make sure you're protecting those online accounts. Go to ifani.com/TBL for $99 off when you sign up. Okay, so now I want to explain to the viewers that in my analysis of Bitcoin, in my practice, I'm a price analyst and I look at the time series of prices. And as I was studying Bitcoin, and I would switch from a normal scale on my y-axis to a log scale on my y-axis, the price, the time series of prices appeared differently, and it appeared to make more sense over multiple cycles than it did to look at it on a normal scale. And in that way, I started to think of Bitcoin as an exponential phenomenon because I'm using that log scale. So, Stephen, you're here to tell me that maybe I was calling it something wrong or understanding it incorrectly. I'd love for you to address my initial misunderstanding and then characterize it for me. What was I doing? What was I observing? And I'll give you the year 2016. So I'm looking at the time series of prices at that time, about 8 years of 6, 7 years of prices for Bitcoin.
Right.
And so I'll pass it to you.
Okay. Well, so there are two things. One is the long-term trend, and the other is we see these bubbles. And the bubbles we know have been quasi-periodic with about a 4-year interval. It seems roughly tied to the halvings, right? To the halving cycle. Those bubbles are of an exponential nature, but that's a rise and a collapse, and that's unstable. But the floor underneath, the long-term trend, is what adheres to a power law. So, it's very common lingo for people to talk about exponential growth when they just mean rapid growth. They mean very rapid growth. So that's just imprecise language from a mathematical standpoint. But as a common lingo, people understand it as very rapid growth. But if you go look at NVIDIA and you look back for 10 years, NVIDIA literally has had exponential growth. It's better fit by a compound annual growth rate that is 68, 69%. I forget which number, but it's one of those two. And it did that over a decade. Prior to that, in its early years, before it really took off, it also had compound annual growth, but it was in the single digits. It was slow. For the past decade, it has been exponential growth, literally, mathematically, with a roughly constant compound annual growth rate. What you find is that exponentials are less stable than power laws.
And so from a Bitcoin perspective, that is a good thing then. It means that Bitcoin's growth is more stable than if it were to actually have experienced exponential or shown exponential growth. All right, Stephen, you have prepared a really great slide deck for us today where we're going to go through your research and the math behind your ideas. I want to, though, jump ahead and give us a preview of where do you think Bitcoin's price is going over the medium long term because it is adhering to this power law?
Right. I think for long term, the trajectory by 2040 would take us to match all of gold. And that's roughly given, even allowing for some increase in the price of gold between now and then, that's in the range of 300 to 400 ounces. So approaching a good delivery bar. But you can do the math pretty quickly because there's 6 billion ounces of gold that's been mined, and it's only growing at less than 2% per year. So you divide that by 20 million, that's 300 ounces per Bitcoin. We know what that price is today. 300 ounces, times...
it's about $750,000 today.
Yeah.
Okay, so an outlook of Bitcoin getting to, let's say, approximately $1 million over the next 15 plus years. And now let's start here with long-term Bitcoin price adheres to a power law. What are the fundamentals to this model?
The fundamentals are two parameters: time and the power law index, which is this how strong the power law is, how rapidly it develops in time. So I mentioned gravity. That's a 1 over r squared. That's an inverse power law, and that exponent is 2. But here we're not going inverse, we're going up, right? We're getting stronger. And it's much larger number. It's closer to 6. So something like time to almost the 6th power of time. And what that means is that if you double the temporal interval, 2 to the 6th power is a factor of 64. We're a little bit less than that, about 5.7. That's about a factor of 50 every time the age of Bitcoin doubles. So that's why when you went from 1 to 2 years, you could go up roughly a factor of 50. Then as you go from 2 to 4 years, another factor of 50. Now to see the next factor of 50, we have to go from 16 years, we're at 16 block years now, to 32. So it takes another 16 years now to get that factor of 50 price increase, which would, take us up well over 3 million.
So let's talk about that block time factor here. You mentioned the halvings. Our block periods between halvings are 210,000 blocks. We've had 4 halvings. What is your idea around the halvings having a relationship with the Bitcoin price, or these once every 4-year genuinely exponential periods of Bitcoin in which it goes into bubble? And I hope I'm using the word correctly there, where for brief amounts of time we're in an exponential rise, 2017, late 2017, and then for periods of 2021 as well. So do the halvings matter is something that we ask ourselves all the time and almost all of our guests.
Yes. I think the influence of the halvings is falling. I do like to do regressions in block years and block months. Block months are convenient because they're all the same length. They're 12 block years. One block year has 12 block months. Each block month is 4,375 blocks. The block years, 52,500 blocks. But there are two reasons. One is because of the halving cycle. The other is because of the difficulty adjustments, right? Because those happen on block boundaries as well, even though they don't line up perfectly. So I think there's some reason for doing regressions on those, but it doesn't matter too much. If you do the regressions on calendar years, you find a somewhat steeper index because, the block calendars move more rapidly, right? The duration of the block years has been somewhat faster than the calendar years. So my general belief is that the influence of the halvings is dropping because inflation is now less than 1%. So who cares? That's not what is driving the dominant supply. The supply that's being taken up is much larger than the new mining production. So it more points to what's the balance on exchanges and what are the other dynamics in the market. I think it did have more impact earlier on when it was making a real difference in percentage terms. And it also has some psychological impact. So there's a market factor there for market psychology for sure. And I think that still applies to some degree.
Teach us about the Lindy effect.
Well, the Lindy effect is about the duration of something. How long will it live? And it's named after a deli in Manhattan that actually no longer exists, but nearly made it to 100 years. And it was a place where comics used to hang out, after they performed their acts and also other people performing on Broadway or whatever. And so the story that developed was, well, the more often you see somebody appearing, eating pie or whatever at Lindy's late at night, the more likely that they're still performing somewhere. And the idea was that the longer you perform, then the longer your lifetime is. So if you've had a good run of a couple of years, the chance that your run is going to extend another couple of years is pretty good. And so this has been adopted to technology. It was actually popularized, among others, by Nicholas Nassim Taleb, who is someone who fell towards and then fell away from Bitcoin. But he wrote about it. It's probably where I first encountered it, was in one of his books. But when you apply it to technology, the idea is that if something lasts for some number of years, then its chance of lasting an equal amount of time or even a longer amount of time is adopted technology. And you might think of VHS or Betamax, for example, which one is going to endure? And Bitcoin, of course, has outlived everything, right? It's got a longer lifetime than any other cryptocurrency. And we've seen many, many fall away.
So we can assume that Bitcoin is going to stick around because it's been around, is basically the idea here. So how long will Bitcoin stick around based off of what we know so far?
Well, at least another factor of 2 beyond its current life. You have to come up with some sort of estimator. And so the estimator I used was just price. How rapidly has the price grown in logarithmic terms? And I found a way to come up with an estimator that says that the persistence, the Lindy persistence, which is this parameter P that gets defined, is about 2.5 times its current age. So given that it's lived for nearly 16 years, that's another 40 years of runway that we may have ahead of us. And of course, we all expect that it's going to probably live longer than that, but it has to continue to prove itself.
Why is the power law versus stock to flow model versus all of these long-term predictions using mathematical models, why is it so contentious, and why is there so much debate in this space around some of these models? And can you explain to me why you believe your approach is more mathematically sound maybe than others? And I also want to layer in one other question, which is that it can't be possible to use these types of models for anything other than very long-term predictions. In my opinion and observation, if you're looking at 15 years of history and looking that Bitcoin might exist for another 40 years because of 15 years, you can't know what's going to happen in the next 6 months or 16 months or 26 months. That wouldn't make any sense to me, but it would make sense that you could make projections 5 to 10 to 15 years out based off of what we know looking back 15 years.
Right. There are two pieces. One is, I agree, essentially. There's this very long-term trend. And what happens is that we find that there's support below the trend, and then there are these bubbles that happen above the trend. And the differentials against the power law are skewed, and they're skewed in a convex manner. You're a bond trader, so you understand that terminology, convex. And so that's favorable, right? We have a right tail skew, and we have this nice strong support, which we will see on the charts, materializes. And if you have, because this is something that's increasing in price so rapidly, and your early instincts were, gee, I have to plot this, the price in logarithmic terms, then we want to look at the differentials from the model in logarithmic terms as well. And what we find that is over the whole span, that the average standard deviation in the logarithm is about 0.3. And that means a multiplicative factor of 2. So 1 sigma is like a multiplicative factor of 2, up or down. 2 sigma would be a multiplicative factor of 4. So that's when you get bubbles. They can go up into that zone, right? When you get Z of +1 or more, running up to maybe +2 as the number of standard deviations. And those are harder to model. The originator or the first discoverer of the power law, Giovanni Santastasi, who is now a colleague of mine, has some models for how those bubbles develop. And those are exponential rises and falls. And then you come back to the long-term power law trend. But how exactly those bubbles can develop, we don't have a lot of statistics on, right? We've basically got 3.5 bubbles to look at. So I don't put a lot of stock in the details of how one models a bubble, but what I do care about is how far above the trend are we? So just taking that z-score is going to tell me something, or how far ahead of the trend am I time-wise, lead lag. That will give me a feel for where I am and might help guide, managing a portfolio or managing what I own.
Okay, so we're on this slide here showing you the way that Bitcoin Z-score evolves over time, and that time being in block years. And what you can see is that Bitcoin has these periods in which it reaches 2 standard deviations above where it should be based off of this power law. So let's just give people a quick math orientation. Today, where does the power law suggest that the Bitcoin price should be? Where are we relative to that, Stephen? And obviously, it appears that we are trending up. We're on the uptrend, and that is because Bitcoin has been basically off of its lows now about 2 years ago.
Correct. So the trend line here, if you do the regression in block years, as this one has, so Z of 0. For the last data point here, which is 15.5, it's a few months ago on this chart. Right now, the last data point would be in the low 60s. And that would be Z0. So we're just a little bit above that right now if we're 67,000 today, roughly. So the upside for 2 sigma would be roughly a factor of 4 above that. So 4 times 67 is, 250-ish. However, this standard deviation is the standard deviation over the whole data set. And if you look in a little more detail, you find that a standard deviation and the volatility have been coming down somewhat. In fact, from epoch to epoch, it drops by about a factor of 0.8 as you go from one epoch to the next. Other analysts have found the same thing, and I agree with them.
Now, can you walk us
right
through?
now, the standard deviation for epoch 5 projected is probably more like 0.21 in the log. And that's a factor of 1.6, 1.7. Square of that would be like 2.5. So 2 sigma might be 2.5, not 3 or 4 times for this epoch.
So 2.5 would put Bitcoin at about 150,000, and the realized price right now at let's call it 30. Let's call it 35 for a little bit more simple math, and put it at 140. You're looking at a MVRV ratio of about 4x. That would put Bitcoin right around 2 standard deviations above its powered law based on this current block period that we are in. So do I understand those numbers correctly, Stephen?
That sounds about right. The realized price is sitting around Z-1 in this chart, right? So
okay, so Z-1, so about 1 standard deviation below trend. Now talk to me about realized price, because that is something that I am absolutely obsessed with conceptually in terms of trying to understand Bitcoin's spot behavior, the behavior of Bitcoin's investors, buyers and sellers. Do you put any value in on-chain data, realized price, or not?
I am not one who's studied realized price in any detail. I'm not a good one to explain it, but it seems to sit close to the support level that we see around Z minus 1 for the long-term trend. And we also do quantile regression. And the quantile regression levels kind of bunch up. So, you can do levels like 5%, 10%, 25%, 50% probability levels and above, right? And you find that the levels at 5, 10, and even at 25% all kind of bunch up. And they bunch up in that same area of where realized price would be and where Z minus 1 is roughly.
So
that's the long-term support that the power law provides. And in fact, if you look at what the equation is for each quantile regression, they each have their own power law index. And you find a somewhat higher power law index down at that support level, and then you find lower power law indexes above, and all the lines are tending to converge in the very, very long term because the volatility has been decreasing somewhat as we go from epoch to epoch.
Now, I want to look at this slide 12 here that you have Lindy power law model, the semi-log and log-log charts. The black line, I'm assuming to be the power law, and the plus and minus 1 lines in green and red show us one standard deviation above and below the model price. Can you just walk us through each one of these graphs and what's the takeaway here?
Right. So your description was correct. So this is showing from age 2 to the latest month, and the black line is the best fit trend for the power law, and it has an index of 5.4. So it's price rising is the almost 5.5 power of the time, right? And then the green line is one standard deviation below using the full data set. So that means it's a factor of 2 below because it's 0.3 in the log. The red line's one standard deviation above. I didn't draw the 2 level, but they correspond precisely to the Z minus 1 and Z plus 1 levels on the prior chart. So that's the left-hand side. The right-hand side is the very same data for price, and it's the very same fit, the best fit trend. So instead of a black line, it's a blue line, but it's the same line, but it's on a log-log chart. And when you plot on a log-log chart, then you get a straight line if it's a power law. So as long as the long term, you have a straight line and you have a good R squared, and we get very good R squared, like 94, 95% for this, then you have some confidence in a longer term power law trend. And just to show that, the power law slowing down doesn't mean that, the price doesn't rise very quickly. That little chart in the upper right is a linear scale, linear chart. So it really does rise very rapidly in linear terms.
And that's why someone like me can make the mistake, or did make the mistake, to describe it as exponential, because your eyes can't necessarily recognize the difference, Stephen. Is that what it is? That when it's linear, your eyes can't recognize the difference between exponential growth and a power law?
Right. And people will say, oh, that's hyperbolic growth. Well, it might be a hyperbola, or it might be an exponential, or it might be a steep power law. And this is a steep power law.
Right. And that's where we hear the term, people are familiar with the parabolic phases of Bitcoin. Now I understand that when I describe brief periods as parabolic rises, it's accurate because it is demonstrating an exponential growth function there during those brief periods. However, we can't say that Bitcoin itself is experiencing parabolic growth over its entire history, because that's not accurate, mathematically speaking, at all. Now, I want to just focus one more second here on this log chart, because this is the main takeaway of the power law here. As Stephen is explaining, the definition of a power law is that the log graph is a straight line. That's why, Stephen. Can you flesh that out all the way? What is it on the x-axis and the y-axis together on a log scale that makes it a power law? Just flesh the whole thing out for us, please.
Sure. Well, there's a scaling relationship. So on the x-axis, we have marked 1 year, 10 years, and 100 years. So this goes out for a very long time. These are in block years, but recently the difference between a calendar year and a block year is very slight. So that was something that early on mattered a fair amount. But as we know, we only went from May to April, right? For the last couple of halvings. So it was quite close over the 4-year period. And then on the y-axis, we have 1, 2, 3, 4, 5, 6, 7, 8 orders of magnitude going from $0.1, 1, 10, 100, 1,000, 10,000, 100,000, up to $1 million. So the green dots are monthly prices. One of the things you're going to notice is, because this is the log of time, is that even though the sampling interval is equal in months, it gets more bunched up as you go on, because the spread gets smaller and smaller on a logarithmic chart. So if you look between 1 and 10, the next line over from 1 would be 2 years. Then you go 2 more, and it would be 4 years. And then you go 4 more, and it would be 8 years. So let's just look at 2 years and 4 years. That would be the second, third, and fourth line, right? And then you've increased by a factor of 2 the time interval. It's gone from 2 to 4 years. But how much did the price go up? It went from less than $1 to over $30. It went up by a factor of 50. It went up from about $0.6, 60 cents, to $30. It went up by a factor of 50. Now let's go from 4 to 8. So that would be the fourth line, 5, 6, 7, 8. It doesn't show the ninth. So the one just before 10, I think, is 8. So you go from 4 to 8. You're going from $30 now at 4 years. And then you go to 8 and you look up, and where does that blue line intersect? That's around maybe 700. Yeah, on that one, it's a little above 1,000. It's about 1,500. So you've gone from 30 to 1,500. It's another factor of 50. It's the vertical line that's right next to the 10. They didn't draw the 9 in because it got too tight when they generated the graph. So there's another factor of 50. So let's go from 8 to now, 8 to 16. So we're $1,500 there. You go up the blue line, and at the end point, you're just around 16. And what does that read? That reads 20, 30, 40, 50, about almost 60,000. So you've gone from 1,500 to 60,000. What's that? That's a factor of 40. So we're off a little bit. But that straight line has a constant factor of growth rate every time you double the amount of time. And that's what you expect for a power law. I gave you that gravity example. You double the distance, it's the square. The gravity strength is 1/4. Here we're getting much stronger. We're getting a number that's 2 times 5.4, which is 32 times 2 to the 0.4, which is, takes us up to some number between 40 and 50 for every doubling of the scale. So that's the important thing. It's kind of a scale-free growth. Every time the scale doubles, you get a certain growth. Or every time the scale triples, you're going to get a corresponding, 3 to the 5.4 power of growth. And so what that means is that the percentage compound annual growth is changing with time. It is getting less with time. Right now, if you do it in calendar years, the projection is about 42% annual growth for the next year. But a year from now, it'll be a little less. It'll be a couple of points lower. But it will still be much, much higher than stocks for the next 2 decades. It's basically, you can get up to that value of all gold and the value of all future M2, not even today's M2, but future projected M2. and still have Bitcoin growing in price at 20 something percent
Now,
if this
Stephen,
parallel relation continues.
so what we're talking about here is, just to boil it all down, we're about 16 years into Bitcoin. Another 16 years, it should go 50x from here, so to about a price of 3 million. That's a market cap of around $60 trillion by the year 2040, and $60 trillion would be, let's just say, 2 to 3x what gold is. It would be shy of probably the US stock market still at that point, but a very large asset class nonetheless. And I want to understand this power law model for gold so that we can have a historical comparison. So can you walk us through the power law model versus gold? And if I miss anything or say anything incorrectly, please correct me, because I'm a little bit of a tourist here.
So this regression I did in calendar years. It was a little bit easier. And so it turns out you get the same power law, 5.4. If you do the Bitcoin price versus fiat, US dollar fiat, you get 5.7 if you do it in calendar time. If you do it in block time, you get 5.4. Here I've done it Bitcoin against gold. I ran an exponential fit. It doesn't fit well. And I ran a power law fit, and the power law index is 5.4. The R squared is 0.94. So it's just as good a quality fit as the one that I showed you against the US dollar. And this is also running over the same time frame. This starts at age 2 years after the Genesis block, and runs to over 15 and a half calendar years. We're now at 15.8 calendar years. So
I'm
if
gonna
time
I'm gonna
increases,
ask you as I'm gonna ask you as a mathematician then to just throw out the math for a second, and from a an instinctual side of things, is it better to measure Bitcoin versus gold, or should we be measuring it versus dollars as we do in the market? And I'm asking you this from purely a theoretical, conceptual standpoint, obviously not the way that we measure it in the market on a day-to-day basis. But if we're thinking about Bitcoin versus gold ounces, and that Bitcoin is going to get to one good delivery bar within the next 8 years or so, that is a price of Bitcoin that's closer to $1 million. And it is the on the same path that you are projecting out using dollars. So the two confirm each other. But conceptually, does it make a lot of sense to think of it like this to you?
It does. I think, gold does not inflate its supply very much, right? It's between 1.5%, 2%. I think it's around 1.8% typically is the increase in the gold supply with newly mined gold. And as we know, over a decade, the M2 money supply doubles, right? So that's 7% compound annual growth in the long term. Now, we've had some bumps, we actually had a strange behavior of a decreasing M2 for a little while recently, but they've managed to turn it around a bit. But it's always going to grow, faster than the gold supply. And so it is a better touchstone in that sense to compare to gold, except it's also the case that gold has higher volatility. But we know that the volatility of the gold price is much lower than the volatility of Bitcoin, certainly than the historical volatility of Bitcoin, even as it comes down. So it does make a lot of sense to think about that.
Stephen, any last thoughts that you want to impart on us as we familiarize ourselves with power laws, how Bitcoin and comparing its price and time have a special mathematical relationship? We appreciate you breaking these things down in language that I can understand, and then hopefully help to translate for others as they battle with trying to understand Bitcoin's value over the long term. I do want to say one thing before I ask you to give us your last thoughts and tell us where people can find your work, which is that I am particularly at the Bitcoin layer not interested in making explicit short and medium term price predictions for Bitcoin. It doesn't feel like a productive practice. With that being said, we firmly believe Bitcoin is going to go $1 million and beyond as it fulfills its destiny as a decentralized money for the world to use. Knowing where gold is today, close to $20 trillion, as a market cap in Bitcoin close to $1 trillion, there's a 20x gap that needs to be filled. Many people out there are trying to explain mathematically why that might be the case, where Bitcoin does catch gold over some of those time horizons. Stephen is helping us explain to us some of that math today. We're very appreciative. A lot of this is it's not speculative, or it's not even necessarily a prediction of the future. It's just looking at past math and applying it to future time. So, Stephen, thank you. And please tell people your last thoughts and where they can find your work.
Last thoughts. Occam's razor says you should use a simple model if a simple model works. And this is a 2-parameter model. And as long as it holds up, we like it. I have a 3-parameter model that I developed because, eventually Bitcoin on a power law would reach 100 trillion, as you've mentioned, and in theory, could go to 1 quadrillion, which would be more than all global wealth. And so at some point, there's going to be some sort of saturation or hyper Bitcoinization, whatever you want to call it. And so I have looked at Weibull curves because they have this beautiful characteristic of being a power law in the early stages, and then they eventually flatten out to some maximum. But they require a 3rd parameter. And when we do the evaluation, we find that the statistical analysis shows really no difference. And we can just stay with the power law. And we think for well into, the next decade and through the next decade. And I can be found on Twitter, X, at Money or Debt, MoneyOrDept.
Stephen Perrenod, thank you so much for joining us today at the Bitcoin Layer. We appreciate your time, and we'll catch you guys next time.
Thank you, Nick. It's been a pleasure.